Hello, welcome back to my podcast. This is episode 2, wherein I'll explain bonds and mutual funds explicitly. We also have a guest speaker, a good friend of mine who is Aditya Jeswani, who will explain a bit of mutual funds to us. Just to recap the last episode, I outlined the basics of shares and derivatives to ensure you would comprehend the later episodes, and in general, to certify you have knowledge that is nowadays deemed compulsory. Nevertheless, in today's episode, I will talk about bonds and mutual funds, delineating their features and capacity for returns. In the next episodes, I will teach you how to evaluate shares, bonds, mutual funds, and when and where to make calls and puts, along with a multitude of other concepts such as currency trading. Let's start off with bonds. As a high level explanation, a bond is essentially a way for someone to participate in lending. To visualize this, let's imagine a company that has $10 million in assets. For the sake of simplicity, it has no liabilities. Currently, the company has 1 million issued shares, implying each share has a worth of $10. Let's say this company wants to expand and buy a $5 million factory. So it will need $5 million more dollars in assets. The question we are posed with now is, how do we finance this endeavor? The first way we can finance this endeavor is through issuing more equity at the same price of $10. So the company can issue 500,000 more shares at $10 per share, which would produce $5 million. This would be sufficient enough to commence the construction of the factory. This is called financing by equity. However, there is a huge quandary with this. It's that company owners must give up a portion of their ownership and dilute their control, something no company owner would want to do, especially if their business is profitable. Hence, we have developed a second mechanism through which a company can finance its ventures. This mechanism is called bonds, which is essentially a second form of borrowing. Let's compare these two methods. Instead of issuing shares, we will acquire bonds. So, therefore, we are basically issuing debt if you think about it. Right now, we could go to a bank, borrow 5 million, and then we would have 5 million in debt and 15 million in assets with the same equity. But no bank would want to give us $5 million in one go. So, what am I going to do now? Let's think about it. Well, if one entity is not willing to give me $5 million, then surely if I borrow from different entities, let's say 5,000 different entities, I'll get the amount of money I require. So I could issue bonds, which are basically certificates where you can receive loans from a plethora of entities which you will eventually have to pay back. Essentially, a bond is a fixed income instrument that represents a loan made by an investor to a borrower. I need to make one important distinction. When I said 5,000 different entities, I did not mean 5 million from each of these 5,000 different entities. I meant a reduced amount from each of these 5,000 different entities. An important thing to note is that these lenders do not receive any profit from the company. Instead, the lenders get paid their interest before the shareholders receive their fair share of profits. These lenders will receive their interest no matter the situation of the corporation. Thus, bonds are a much safer alternative to acquiring shares. In this scenario, our bonds have a face or par value of $1,000 with a 10% annual coupon. A coupon is just the rate of interest the company will pay you, and a bond always has a maturity date which we have not expressed here, but let's say, for instance, in this example, it is going to be 2 years. So I will have to issue 5,000 bonds of these to finance my $5 million factory, because 5,000 times 1,000 is going to give me 5 million. Let's say you were a lender. You thought this bond was reasonable and you acquired it. So when you do this, you are essentially lending the company $1,000 through a bond. There's one thing we must clarify though, how the company pays the sum of money back to you, the lender. The company the coupons tend to be paid semi-annually. And because we said the interest is 10% annually, which is $100, you will receive $50 every 6 months. So each 6 months for 2 years, you'll receive $50, and then by the maturity date, you will receive an additional $50 to finish off the interest payments plus your entire principal. Moving on, government-sponsored enterprises, agencies, and corporations issue bonds to raise money for their endeavors. The financial health of the issuer determines how highly or not the bonds are rated. Higher rated bonds are considered to be safer and therefore pay less interest, whereas lower rated bonds pay higher interest rates to compensate investors for taking on more perceived risk. Generally, as a rule of thumb, government-sponsored enterprises, and agency bonds are safe investments as they are backed by the government. However, they provide low yield. Corporate bonds are risky, but yields are much higher. The yield on corporate bonds tend to vary directly with the risk of purchasing said bonds to entice investors. There's one thing to remember though. If the coupon rate of the government bond is below the rate of inflation, generally you should stay away from that investment. You will lose money out. Now, let's formalize and just visualize what I had said earlier about the different components of a bond. There are very few, so it's quite easy to understand. There are only three major components of a bond. The first one you have is the face value, which is also called the par value. This is the value the bondholder or the lender will receive at maturity unless the issuer defaults. Investors pay par when they buy the bond at its original face value. If coupons are retired by the issuer before maturity, bondholders may receive the par value or a slight premium. The price investors pay when buying on the secondary market is not going to be the same as the one you pay from the primary market. It may be more or less than the actual face value, because the face value is what the company publishes, and that is released into the primary market, not the secondary market. Now, bonds have a coupon rate, which is just the annual interest of the annual rate of interest, my bad. So the term coupon is quite interesting. It harkens to the time bond certificates were issued on paper and had actual coupons that investors would detach and bring to the bank to collect their investments and their interest. So again, like we said, the higher the coupon rate, generally the riskier the investment tends to be. Moving on, we have a stated maturity date. Generally, this is the date on which the money you have loaned the issuer is repaid to you, assuming the bond is not the bond issuer has not defaulted. Thus, bonds present a safe manner through which an investor can increase their wealth without facing much risk. One should also invest in bonds. You should also invest in bonds along with shares and various other financial assets. Diversify your portfolio. Depending on your financial stature and ambitions, you should decide how much capital you invest in bonds compared to stocks. I've spoken to many people and they have a 70-30 split between equity and bonds. But of course, that varies on your risk appetite and your financial goals. Before we move on, I would like to explain where you can buy bonds. For corporate bonds, many specialized online bond brokerages require high minimum initial deposits to purchase these bonds. Typically, this ranges around $5,000. There may be also account maintenance fees and commissions on trade. These commissions on trade depend on the quantity and type of bond purchased. A broker commission can charge around 2% to 0.5%. When using a broker to purchase bonds, you may be told that the trade is free of commission. What often happens, however, is that the price is marked up so that the cost you are charged essentially includes a compensatory fee. If they're not going to take anything off the transaction, these brokers, why would they offer you the service? So, for instance, let us say you purchased 10 corporate bonds that are trading at $1,025 and you were told that actually they cost $1,035.25. So the total price of your investment amounts to $10,352.5 instead of $10,250. So this difference represents an effective 1% commission for the broker. Now, to determine the markup before purchase, look up the latest quote for the bond, which you can see on Trace, which is the trading report and compliance engine, or over-the-counter transactions. You can consult those too. Use your discretion to decide whether or not the commission fee is excessive or one you're willing to accept. I would say if it's higher than 2%, you should refrain from that. Purchasing government bonds such as treasuries, which are US or Canadian saving bonds, works slightly different than buying corporate or municipal bonds. Many financial institutions provide services to their clients that allow them to purchase government bonds through their regular investment accounts. If this service is not available to you through your bank or brokerage, you also have the option to purchase these securities directly from the government. Now that we have concluded our segment on bonds, let's move on to mutual funds. I'll break mutual funds really simply for you using this example. Assume that I have to go from New York to Washington. Hypothetically, let's say, even as a kid, I can drive from New York to Washington. However, I choose to hire a driver to take me from New York to Washington. This driver will decide how fast he should go, what roads should he drive on. I just tell him my starting destination, my initial point and my final destination. This is the exact difference between a stock market investment and a mutual fund investment. In a stock market investment, you take all the decisions. You know where to go and how to go. Nonetheless, if you cannot be bothered to research stocks and do your due diligence, you can invest in a mutual fund where a professional will take decisions for you. Essentially, in mutual funds, there is a mutual funds manager who takes decisions with the money you have invested in the fund. A mutual fund will collect money from people like you and me. So let's say 100 people have contributed towards a mutual fund wherein they invest money. This mutual fund will take this money and it will invest it into different investment opportunities such as bonds, equity, debt, etc. One common question that I hear a lot, especially on live streams and forums, is how are mutual funds priced? Many mutual funds use the net asset value of their portfolio to determine the price for transacting units of the fund. When you buy and sell mutual funds, you typically do so at the NAV. What is the NAV? Well, it is the net asset value of the fund, which represents the net value of the entity and is calculated as the total value of the entity's assets minus the total value of its liabilities. For most mutual funds, the NAV is calculated daily since a mutual fund's portfolio consists of many different stocks. As each one of these stocks may change in price frequently throughout the day, an exact value of a mutual fund is difficult to determine. Thus, mutual fund companies have chosen to value their portfolio once a day and each day. This is the price at which investors must buy and sell the mutual fund. This exact valuation technique may vary from fund to fund, as some may use an average of the last 3 traded prices or use this technique. However, each and every mutual fund sets a valuation of the NAV once a day. The price paid for the shares purchased of the fund is based upon the new NAV combined with any purchase or redemption load fees that are due. As we had said earlier, the NAV is calculated daily after the market closes in order to determine the closing market value of all the combined securities held by the fund minus the fund's liability. This figure is then divided by the fund's total shares outstanding, which results in the NAV per share for that day. So our shares outstanding, as you know, is just the number of issued shares / the shares that a company's shareholder owns. Buy and sell orders for that day are then executed using that NAV. There are 3 ways through which investors make capital through a mutual fund. First, we have price appreciation. That is very simply you making money from the appreciation and depreciation of securities in a fund. So when the stock of a certain company, let's say Tesla, goes up, you net since the fund you have invested in has purchased that stock. Then you have dividends, which again we know are from shares, which we have talked about in our previous episode. Anytime a company declares dividends and you receive that, what happens is, as a mutual fund holder, you can either invest that again into the mutual fund or just take it for your own profits. There's always an option. Typically, when you open up a brokerage account, that typically comes up. And thirdly, you have interest payments, which is the interest paid to the fund, which may come from coupon payments from bond holdings or from cash equivalents held by the fund. The way they pay the interest earned is congruent with how they distribute dividends. So again, the investors in the mutual fund can take it for themselves or reinvest it into the mutual fund. Now we must talk about something which is very important, which is how do mutual funds make money? If they don't make money, what is their gain? They do indeed make money through 2 manners: management fees and sales charges. Why am I telling you this? Well, this is how you will compare different funds and see which one is the best for you. See, us investors have to pay these funds. Additionally, sales agents or intermediaries, such as brokers or commission-based financial planners and advisors, may make money from mutual funds through sales charges or commissions, or from 12B-1 fees. It is important you understand how a mutual fund makes money, as you can then observe these parameters in the prospectus and decide whether it is appropriate to invest in them or not. For example, if you believe the sales charges are too high, then you should not invest in that fund, as it will diminish the size of your investments. Management fees are charged either monthly or quarterly against the assets of the fund and are collectively referred to as the annual expense ratio. An expense ratio is an annual fee expressed as a percentage of your investment, or like the term implies, the ratio of investment that goes towards the fund's expenses. If you invest in a mutual fund with a 1% expense ratio, you'll pay the fund $10 per year for every $1,000 invested. So that is taking away from your investment, not from your returns, but from your investment. In addition to management fees, funds are permitted to charge separate marketing and distribution fees called 12B-1 fees. These fees are capped annually at 1% and are frequently used to pay the fund's internal salespeople or outside sales agents when funds are offered with little or no sales charges. So, for example, a mutual fund has an average annual net asset of 20 million. A company charges 1% of the net asset as a 12B-1 fee. This means that the 12B-1 fee is equal to $200,000, diminishing your returns. Now, let's say the company takes 0.75% of that 1% fee as a service fee and the other 0.25% as a distribution fee. Thus, the service fee will become 150,000 and the distribution fee will amount to $50,000. Since these fees are paid to third parties, they will not be included in the published management fee for your mutual fund. As a rule of thumb, look out for funds that charge 12B-1 fees and aim to steer clear from them because eventually these fees will eat up your returns. If you do have funds that take away from your returns through high 12B-1 fees, remember that there are always other options available. In addition to all of this, there's this final fee, which is called a sales charge. A sales charge is a fee paid by an investor that is used to compensate the broker or salesman for effecting that transaction. Many mutual funds have sales charges, which are quoted in percentages and equate to a portion of the investment. By regulation, the maximum permitted sales charge is 8.5%, but most loans fall within a 3% to 6% range. For example, if I invested $100,000 and the sales charge is 5%, then I would have to pay $5,000 in sales charges. This is all good to know. But how do I buy a mutual fund? Well, my guest speaker and very good friend, Aditya Jeswani, will explain this right now. How are you doing, Aditya?
I'm doing well. How are you?
I'm doing great. Tell us something about yourself.
Well, I'm an avid investor. I'm 15 years old. Investing has been something I enjoy a lot, and I've pursued this extensively. In fact, my earnings have been $35,000 this year.
Wow, that is great. Now, the viewers want to know how they can invest in a mutual fund. Could you shine some light on this?
Sure. So there's two basic manners through which you can acquire a mutual fund: investment corporations or online brokerages. One often overlooked option is to buy a mutual fund directly through the investment companies that offer and manage them. Mutual fund companies range from publicly traded giants like T. Rowe Price to private boutique firms like American Century or Dodge and Cox. Each firm offers at least a few different mutual funds, from passive index funds to actively managed equity funds to high yield bond funds, designed to appeal to different investors and different investment goals. One key advantage of buying directly from the mutual fund company is that there's no sale commissions or brokerage fees taken from you, where most of your investment dollar goes into the fund and right to work for you. The key downside of this is that your investment options are limited to that company's family of funds. Yet another option is to open an online account at a brokerage. It will likely be the most expensive course. Typically, these type of accounts charge a transaction fee and a commission for each trade, and they may also charge for other account setup or maintenance fees. However, they will provide the biggest universe of mutual funds to choose from. It is fairly simple to find an account with relatively low fees, especially if you comb the ranks of discount brokerages. Among the hottest and cheapest are exclusively online companies such as E-Trade and Betterment.
That has to for sure clarified all the viewers' doubts. Thank you for your time.
Welcome, anytime.
Before we conclude today's podcast, we would like to tell you the advantages to investing in a mutual fund. It reduces risk as it diversifies your portfolio, gives discretion to an astute financial manager, and reduces much of the work that is required when analyzing securities. Alright, everyone, thank you so much for tuning into today's podcast. Today, we spoke about mutual funds and bonds and give you all the necessary information required for you to not only understand them but get a basic sense regarding where you should invest your money. In the following podcast, we will solidify this basic intuition you have built, giving you clear and coherent guidelines as to where to invest your hard-earned money. It has been a pleasure. See you on the next episode. Goodbye.